Chapter 7. Investments. Warren Buffett once said, "Don't be proud of your salary, be proud of your investments." This is because investing is the key to financial success. Through investing, you will be able to decrease the time spent working for money and spend that time letting your money work for you. To do this, you must first understand what investing is. Put simply, investing is the process of buying an asset with the expectation it will increase in value. That could mean buying real estate, stocks, crypto, or even a Rolex watch. Whatever the asset, if there is a market and a return can be made, it can be considered an investment. With that said, every investment is made up of three key characteristics. These characteristics include risk, return, and liquidity. Risk. Risk is the probability your investment will produce a loss rather than a profit. It is also one of the first things to consider when evaluating an investment opportunity. In most cases, the greater the risk, the greater the return, and vice versa, the lower the risk, the lower the return. You must be comfortable with risk when deciding to invest. If you have a low risk tolerance, you may want to focus on investments that offer low risk. You don't want to be losing sleep because you are worrying about your investments. Return. The next thing to consider is the return. The return is simply the profit or money made on an investment. Analyzing the return on investment is a great way to compare potential investment opportunities, especially if they have similar risk. For example, say you had an opportunity that required an investment of $10,000 and had a potential return of $1,000. Then, say you had an opportunity that required an investment of $50,000 and had a potential return of $3,000. On the surface, it may appear the second opportunity, with a return of $3,000, would be a better investment. However, the second investment would require 5 times the investment for only 3 times the return. That said, the first investment would have a higher return. A simple formula for calculating return on investment is return divided by investment. In the example above, the first investment would have a return of 10%, $1,000 divided by $10,000. The second investment would have a return of 6%, $3,000 divided by $50,000. Again, you can use this formula to quickly compare potential investment opportunities that have similar risk. Liquidity. The last characteristic of an investment is liquidity. You should always consider liquidity when evaluating an investment. Liquidity is the ability to sell or liquidate an investment. Like risk, the liquidity of an investment will have a direct effect on its potential risk. That said, you can expect higher risk for an investment with low liquidity, whereas a highly liquid investment may have lower risk. To give you an example, a house or other forms of real estate would not be considered liquid. That is because it could take months to sell and receive cash for your investment. A rare painting would also have low liquidity. Precious objects often have a limited or select number of buyers, which makes selling more difficult. Again, the harder to sell, the lower the liquidity. On the other hand, investments like stocks, bonds, and some cryptocurrencies would be considered highly liquid investments. That is because they can be converted to cash relatively quickly. If you have ever bought and sold stock using an app like Robinhood, you know a stock can be liquidated or sold in a matter of seconds. That is why liquidity is so important when it comes to investments. If the value of your investment begins to drop quickly, being able to sell and cut your losses becomes increasingly important. The higher the liquidity, the easier it will be to sell. This is also important in case you have an emergency or another investment opportunity presents itself. Having the ability to quickly liquidate an investment will give you the flexibility to adapt and restructure your investment portfolio. Investment strategy. Finally, before you begin on your investment journey, it is important to create a basic investment strategy. The first step in creating an investment strategy is to look at your current financial position. You will want to look at your monthly income and expenses to help determine how much you will have to invest. You will also want to look at any outstanding debts or liabilities that may affect your ability to invest. Remember, it doesn't take a lot of money to begin investing, and it is better to invest a little than to not invest at all. Next, you should decide on your investment approach. Mainly, do you want to be an active investor or a passive investor? Active investing is more of a hands-on approach, while passive investing is more of a buy and hold strategy. For example, day trading stock options or buying houses to fix and flip would be considered an active investment approach. On the other hand, investing in index funds or buying a rental property would be considered more of a passive investment approach. Both can be successful, however, passive investing presents less risk and may be better suited for people just starting out. Lastly, you will want to consider your goals. Are you investing for retirement or looking for an immediate return? Knowing this will be important when deciding what type of investments to pursue. With so many different investment options, an investment strategy will help you decide which opportunities are right for you. That said, let's look at 5 common types of investments. 5 types of investments. Number 1. Stocks and ETFs. Stocks or equity securities are financial assets that represent ownership in a company. Corporations issue stock in the form of shares as a way to raise funds and grow a company. Public companies list their stock on exchanges like the Nasdaq or the New York Stock Exchange. Buyers and sellers then use stockbrokers to purchase and sell stock from these exchanges. By purchasing shares of a company's stock, you would obtain an ownership interest in the company and be what is called a shareholder. Shareholders have voting rights, are entitled to dividends, and have the right to sell the shares they own. That said, there are 2 main ways to earn income from stocks. Those 2 ways are dividends and appreciation. Dividends are a distribution of companies' profits in the form of cash payments. They are paid on a per-share basis, and the amount is determined by the company's board of directors. The other way to earn money from stocks is through capital appreciation. Appreciation is simply an increase in the share price or value of the stock. For example, if you bought a share for $100 and it is now worth $150, you would have gained $50 through the appreciation of the stock. Over time, appreciation offers investors the greatest potential for profit. At the same time, there are no guarantees when it comes to stocks and the stock market. Poor company performance, volatile market conditions, and a bad economy can all have a negative impact on a stock's share price. For this reason, stocks are generally considered a high-risk investment. However, using a buy-and-hold strategy can help to mitigate the risk of stock investment. That is because historically, stocks outperform other investment classes when held over a long period of time. Another investment option similar to stocks are ETFs. ETF stands for Exchange Traded Fund. Like stocks, ETFs are listed on the New York Stock Exchange and can be purchased in shares. The main difference between stocks and ETFs is stocks represent a share of one individual company, while ETFs can be made up of hundreds or thousands of companies. The fact that ETFs can be made up of several companies from various industries or sectors make them popular with investors seeking diversification. Diversification can help reduce the risk of a downward swing in a single stock. However, that also means you won't benefit as much from a large upward swing in a single stock. Simply put, ETFs offer increased stability when compared to individual stocks. This makes it an attractive investment if you are looking for steadily increasing earnings over a long period of time. Number 2. CDs and bonds. CDs and bonds are some of the safest investments you can make. Both offer returns with little to no risk and provide an alternative to a traditional savings account. A CD stands for Certificate of Deposit. A CD is a type of savings account that pays interest on a fixed lump sum deposit. In return, you agree not to withdraw your money during the term of the CD. The term of a CD can range from as short as 6 months to as long as 5 years. In most cases, the longer the term, the higher the interest rate. However, if the principal deposit is withdrawn early or prior to the end of the term, you will most likely face a penalty that could eliminate most or all your interest earnings. For example, say you deposit $1,000 in a 12-month CD that has an annual percentage yield of 4%. During the 12-month term, you would not be allowed to withdraw your money without facing a penalty. At the end of the first year, your CD would be worth $1,040, giving you a profit of $40. Now, some may not consider this a true investment since the return is much lower than other investment options. However, with low risk comes low reward, and CDs are as safe as it gets. In fact, the Federal Deposit Insurance Corporation guarantees them up to $250,000. Bonds are another low-risk investment option. Like CDs, bonds pay interest on a fixed lump sum deposit. They also come with a time commitment and the possibility of penalty for early withdrawal. Bonds are normally issued by governments and companies looking to raise money. The bonds are then backed by the government or organization that issues them. This means, if that government or company fails, you could potentially lose your principal investment. For this reason, bonds are rated by agencies like Moody's and Standard & Poor's. The bond rating will assess the creditworthiness of the government or organization issuing the bond. The highest possible bond rating is AAA, and U.S. Treasury bonds are the most common AAA-rated bonds. Again, CDs and bonds are some of the safest investments that also have high liquidity. However, the returns can be modest and are geared for a more conservative investment strategy. Number 3. Cryptocurrency. Cryptocurrency, or crypto for short, is a relatively new investment class. Cryptocurrency is a digital currency, or asset, that began with the creation of the Bitcoin blockchain. Over the past 4 years, there has been an explosion in cryptocurrency. That said, there has also been a growing concern regarding the stability and longevity of cryptocurrency. The collapse of the crypto exchange FTX and the drastic decline in prices has proven that crypto, as an investment, can be highly unpredictable. For this reason, cryptocurrency should be considered high risk and purely speculative. To begin investing in crypto, consider buying crypto directly, a crypto ETF, or crypto stocks. Remember, it is important to manage risk with all investments, but even more so with cryptocurrency. Make sure you have a plan, use a reputable crypto exchange, and only invest what you can afford to lose. Number 4. Real estate. Real estate is one of the oldest and most reliable investment options. Business tycoon Andrew Carnegie once said, 90% of all millionaires become so through owning real estate. Real estate can include vacant land, residential properties, and commercial properties. That means any property you buy with the intention of making money can be considered real estate investing. This includes buying a home to live in, purchasing a rental or Airbnb, or acquiring a fix and flip. Real estate is widely considered to be a low-risk investment as it tends to appreciate over time. However, it is important to note, real estate is not considered a highly liquid investment. In the case you need to sell your property quickly, you could be forced to sell below market or at a loss. For this reason, it is best to consider real estate as a longer-term investment. For more information on real estate investing, make sure to listen to Chapter 5, which covers real estate in detail. Number 5. Precious objects. Anything of value, purchased with the goal of reselling for profit, can be considered an investment. That is why precious objects should be considered investments. Precious objects include gold, silver, rare coins, and jewelry. It can also include artwork, comic books, and sports memorabilia. The fact is, if its value appreciates over time, someone will invest in it. That said, investing in precious objects can be highly volatile. Niche markets usually have fewer buyers, and with fewer buyers comes low liquidity and higher risk. Precious objects are also prone to physical damage. Special attention must be given to how they are stored and maintained. Keep this in mind, as the quality and condition of the object will play a big part in its value. Do your research. Benjamin Franklin once said, "An investment in knowledge pays the best interest." Well, when it comes to making investments, this could not be more true. Whether it be stocks, real estate, or comic books, it is important to do your research. In fact, before you invest in anything, I would recommend you learn as much information as possible. That means not only understanding the market or industry you are investing in, but also know the markets or industries that may impact your investment. You should also research any regulations or laws that can affect your investment. The more you know, the better your chances of being successful. Understand, current and future trends are important, but the past also has a history of repeating itself. In the end, research could be the difference between a significant profit or a devastating loss. Invest wisely and good luck.